Hello, and welcome into the Traction Financial Partners 2025 Q3 Market and Economic Recap. I'm Evan Barnes, CIO and co-founder of Traction Financial Partners.
And I am Drew Barnes, Director of Financial Planning with Traction Financial Partners.
We appreciate you joining us on the recording today. We are going to be recording every other of these economic updates that we do. We do it quarterly. We're going to do a January live webinar. Then we will be doing a July live webinar as well. And the quarters in between, we will be recording. We want to make sure that we're being respectful of your time. And I know that a lot of times it's just easier to watch the recording. So again, thanks for joining us. Always happy to have you here and excited to go through this with you. If we can go to the agenda here, we'll get us going. Okay, today's agenda, Drew is going to be going through the year-to-date equity markets overview of where the stock market's at. I will then be taking us through the 2025 year-to-date fixed income and key interest rate overview. We'll kick it back to Drew for an economic update, and we will wrap it up with some markets in perspective. And so I will kick it over to Drew here to get us into the 2025 year-to-date equity markets overview.
Thank you, Evan. So when we look at the markets through 3 quarters so far in 2025, we are experiencing yet another positive year with pretty impressive returns from the markets. So the data that we're looking at right now is actually through the end of last week, through October 17th. So it's a little more current than the end of the third quarter. And if we're looking at the second line here, year to date, the S&P 500 is up nearly 14.5% this year. So it's been a continuance of what we've seen the last few years as we came out of the bear market, which bottomed in October of 2022. And if we look over to 2024 here, the S&P 500 was up 25%. It was also up over 20% in 2023. So we're on our third consecutive year of really strong performance from the primary indices that we like to review in the S&P 500, the top 500 companies in the U.S. market. The line below that, the NASDAQ 100, which is our tech-heavy index, up nearly 19% on the year versus 10% from the Dow Industrial Average here on the top line of about 10%. And the Dow is going to have a much greater mix of value-oriented companies. So if we look here at the S&P 500 growth versus the S&P 500 value, we see that similar split of about a 10% outperformance from the growth area of the market. And if we come over here to 2024, it's a continuance of what we saw last year where growth greatly outperformed value. We're seeing that again this year. The spread's not quite as large, but nonetheless, we're seeing, as we'll see here in a few slides, we're seeing these large growth, primarily tech companies, lead the way for the market. If we go down here to the Russell 2000, which is the primary small cap index that we like to track, it's up about 11% on the year. So it's had a solid year as well, not quite as strong as the S&P 500. And there's various reasons for that. Small cap companies, don't have as large of earnings and also, don't have quite as strong of balance sheets as some of the larger companies. So the things like tariffs are a little harder to absorb for small companies. And as Evan will get to later on, when we talk about the Federal Reserve and interest rates, if we do see the Federal Reserve continue to cut interest rates, that could be a good sign for small caps because small caps tend to borrow a little heavier than larger companies. And if they're able to do so at lower rates, we could see good returns from small caps moving forward. And then the brightest spot of the markets year to date, if we look at the MSCI EFI index, as we call it, Europe, Asia, and the Far East, or Europe, Australia, and the Far East, excuse me, up north of 25%. And then the second from the bottom, emerging markets, which are developing nations, leading the way at 29%. So it's been a strong year for the international markets. And as you all know, we always have an allocation to international markets. So not only do they provide nice diversification for us, they're actually providing some outperformance to the US market this year. And what we have here on the screen is something we like to always remind our clients, and we pull this chart up periodically to let our clients know that as investors, we do need to understand that we're going to experience some volatility in the markets. So if we look at the red dots on the screen, these are the biggest intra-year declines in the S&P 500 for the year. And then the gray bars are the performance at the end of the year, or year to date in the case of 2025 there on the far right. So as we can see on the far right, we were down 19% from at our lowest point this year. That happened in April as the tariffs were rolled out, and the markets did not like that initial tariff rollout. And as we know, we've worked a lot of trade deals with other countries at this point. And as we've seen in corporate earnings, which are remaining incredibly resilient and actually quite robust, the tariffs have not been a hit to the bottom line for companies. So despite an average intra-year decline of about 14%, this goes back to 1980, so through 45 years, despite that average drop of about 14%, we've been positive in 34 of these 45 years, or about 75% of the time, maybe a little higher. So again, as investors, we always know that we're going to experience a little bit of volatility. And if we remain patient and optimistic, the market has always come back and rewarded us. And as you can see, the gray bars on the upside, when the market's positive, tends to be positive by a higher percentage than when the market's negative as well. So it's positive north of 75% of the time, and it's positive by a greater degree than when it's negative. So, we're happy to say that all of you, our clients, we had 0 clients panic and sell out of the market in April this year when we experienced nearly a bear market, which is defined by a 20% drop. Everyone has been rewarded, and the market's up well north of 30% since that bottom in April. Okay, so we thought this was an interesting chart to share, and it's the market capitalization of the top 10 stocks in the S&P 500. And it goes back through the decades, going back to 1985, 1985, 1995, 2005, 2015, and then the start of this year in 2025. So what's important, there's 2 main takeaways here. One is that the top 10 stocks historically, as we can see on the left-hand side, have generally represented around close to 15 to 20% of the entire index. Whereas right now, and it's actually eclipsed the 40% mark, but coming into this year, the top 10 stocks represented nearly 40% of the S&P 500, whereas that means the remaining 490 stocks represent the other 60% approximately. So that's kind of the main takeaway, is that we're seeing a really large concentration in these top 10 companies. And as you can see, we've got Apple, NVIDIA, Microsoft, Amazon, Alphabet, which is Google, Meta, which is Facebook, Tesla, Broadcom. And then we do have 2 non-tech stocks here in Berkshire Hathaway and JP Morgan. So these major tech stocks have really been driving things the last few years. And that's largely in part due to the AI boom and these companies being such large investors in that space. So the vast majority of that's made up from large tech stocks, where if we look back at the top 10 stocks in these other decades, we see a much more diversified mix In 2015, we had Apple, Exxon, Microsoft, Johnson and Johnson, so on and so forth. 2005, GE, Exxon, Microsoft, Citigroup, Walmart, and we can see what it looked like when we were in the 90s and 80s as well. So as our economy has shifted into a high-tech economy, we're seeing less diversification amongst the top 10 stocks, really driven by these top 10 tech stocks, or eight of which are tech stocks. So does that what does that mean moving forward? Well, there's been such a robust investment in AI moving forward that for these large tech companies to continue performing quite well, we are needing to see that build out come to fruition. So we're obviously going to keep a close eye on that. But as AI becomes more widespread and integrated into other industries, it would not be surprising to see the top 10 become more diversified again, because while AI is, of course, a technology, we do expect all these other companies to start integrating that technology into their companies as well. And they should therefore benefit from it. So, along those lines, if we look at these top 7 tech stocks here, we can see on the left-hand side, we've got NVIDIA, which is now the biggest stock in the world by market capitalization, Microsoft, Apple, Meta, Broadcom, Amazon, and Google. They've made up nearly 50% of this current bull market advance that we're in the middle of since October 12th of 2022, when the market hit bottom down about 26% that year. With that, the other 493 companies in the S&P 500 have represented about 52% of the returns. So again, just kind of further evidence that, it's really these major tech stocks that have been driving things. And as you know, we believe in broad diversification. So while we're very happy to have these companies providing such strong performance, we always know that we can't become too concentrated just in a handful of companies, because if they falter, we do not want the whole entire portfolio to falter. And then to wrap up my piece here on the equity markets, and this is not really equities, but commodities, which we're always keeping an eye on because they have broad implications for primarily inflation, which of course impacts consumers, and therefore what is the Federal Reserve going to do? Because inflation is a key component of their decision-making process for rates and their balance sheet and things like that. So on the top line here, we have oil, which we can see started the year, or not started the year, but about 12 months ago is at over $71 a barrel. Currently, that's down nearly 20% at about $57.49 a barrel. And below that, we can see gas prices have gone down as well. Gas prices haven't gone down quite as much, but I believe I saw in the news that the national average is now below $3. And in some parts of the country, we're actually seeing it around $2. So gas is continuing to decline, which is very welcome for consumers, as it's been pretty elevated the last handful of years. But what's really impressive, I would say, to point out on this is what these precious metals have been doing. So we can see gold here was just under $2,700 an ounce a year ago, over $4,200. Silver, $31.81, now $54.10. And we don't have every precious metal on here, but really you see platinum, so on and so forth. All these precious metals are really driving prices higher. There's a handful of reasons for that. One is instability, really across the globe, where you have, conflict in the Middle East, conflict in the Eurasian landmass with Russia and Ukraine, and then also, large government debt. U.S. debt's nearly $38 trillion now, and continuing to run large deficits. The fiscal year end just came up at the end of September, and we ran just under a $1.8 trillion deficit. So as a result, these precious metals are doing well as investors and central banks increase their allocation to things like gold and silver, kind of as that insurance policy against potential turbulence. And with that, I'll kick it back to Evan, who will go through the fixed income landscape for the year and discuss some key interest rates.
Thank you, Drew. All right, what we're looking at here is on the top half of the screen, top corner of the screen, is the fixed income returns so far this year. And the top line, the U.S. aggregate bond index, kind of the S&P 500 version on the bond side of things. Year to date, having a really solid year. We were fairly positive on fixed income coming into 2025 with the idea that interest rates might drop. And as interest rates drop, we have a teeter-totter effect with the price of bonds. And so lower interest rates, which I'll talk about here in a second, improves the price of existing bonds. And so year to date, we're showing a 7.23% return on the U.S. aggregate bond index. U.S. corporates slightly better at 7.87. Municipals, which have tax favorable treatments on interest, that we use a lot in our after-tax portfolios at 5.1%, and then high yield bonds just over 7. So again, a really solid year so far when it comes to returns on our fixed income portion of our portfolios. And a lot of that has to do with what's going on with interest rates. If we look at interest rates on the bottom half of the screen here, we'll focus on the top two first. 2-year U.S. Treasuries and 10-year U.S. Treasuries. Okay, you can see coming into the year, the 2-year U.S. Treasury was at 4.25%, while the 10-year, which is kind of the broad interest rate that the market really focuses on. A lot of loans are based off the 10-year. The 10-year interest U.S. Treasury was at 4.58. If we go to the far left side, you can see where we are currently. The 2-year has had quite the drop. Again, from 4.25 down to 3.46, and about a little bit over 0.5% drop on the 10-year from 4.58 down to 4.02. So we have seen interest rates in the market come down this year. We'll talk more about the Federal Reserve here in a second. That definitely plays into it. But as interest rates have come down, that has improved the price of our existing bonds. And as you move down the list here, we'll focus on the bottom two now. The 30-year fixed mortgage. So coming into the year on the 30-year fixed mortgage, we were looking at around 7.28% national average. And now it's down to 6.39. Okay, so again, a nice drop, almost a percent drop on mortgage rates, but we have seen a struggling real estate market. Kind of depends where you're at, but overall across the country, real estate has certainly slowed down. There's about 500,000 more sellers in the market currently than there are buyers. Prices have started to come down during the summer. The Denver metro area was one of the top areas in the country in terms of price cuts on listings. A lot of it has to do with this, with the 30-year fixed mortgage, where a lot of folks who currently own may have interest rates in the 2.75, 3.5% range. So if you're going to move, take on potentially a bigger house because prices haven't come down as much, bigger mortgage, double the interest rate, that could be lifestyle change, right? So that's why we've seen houses stay on the market a whole lot longer than we had been seeing for many years. So watch the 30-year fixed mortgage. That's directly impacting what's going on in real estate. And then at the bottom there, the prime rate is the interest rate that the highest credit quality businesses get in terms of their loans. 7.25, it was at 7.5 for quite some time. Until just recent cuts over a year ago, it was at 8. And so the businesses, again, still higher interest rates. Drew mentioned it when we talked about smaller cap companies on the equity side of things and how they've struggled a little bit this year compared to the larger companies, because if you're a business and you're borrowing more with higher interest rates, it's definitely going to squeeze your margins. So we're always tracking this as well to see what the borrowing costs are for businesses. Drew went through this very similar slide on the stock side of things on the S&P 500. Okay, so we feel and we see the volatility on stocks much more than we do on bonds just because it's more pronounced, more dramatic. But there is volatility in bonds as well. And so you can see this is going back to 1976. So that's 49 years worth of returns. In 44 of those 49 years, we've seen a positive bond market in terms of year-end returns. Okay, so that's a pretty good percentage there that bonds typically are going to give us some type of positive return. They do have the average drop each year. Again, the intra-year drop, the largest that we see, averages around 3.5%. If we look year to date, okay, year to date, this is through the end of September. So as we mentioned before, the aggregate bond index is actually higher in this now, but through September we were at around 6. We did have a 3% drop though earlier in the year in bonds as interest rates were starting to go up at the beginning of the year, and now we've seen that reversal, which has helped out our bond prices. The worst year on record for bond was back in 2022. This is Drew was mentioning that we've been in a bull market since October of 2022 on the equity side of things, and bonds have found their footing as well. That was worst year on record. Finished the year down 13%. At one point, there was a 17% drop during that year. Again, that was when inflation was at 9% during the summer of 2022. The Federal Reserve increased interest rates dramatically to try to slow down that inflation. So that was the opposite side of the teeter-totter. When interest rates spike up, existing bond prices got hit, and they got hit pretty good in 2022. But so far this year, we've had a positive year on the fixed income side, just as we had thought would be the case coming into this year. What if interest rates continue to go down? And so what this is showing us here is the hypothetical total returns for a 1-year period if interest rates drop by 1%. Okay, so the very top one, the Bloomberg US Treasury 5 to 7 year bond. On the right-hand side, you can see the yield, right? So if interest rates don't move at all, that's the yield, the interest you're getting off of this. You'd get 3.84% rate of return over 12 months. The duration, which is the risk in terms of number of years on bonds, at about 5.5. The way that returns on bonds work, if you're looking to kind of predict based on what interest rates do, is if interest rates go down 1%, the price of those bonds are going to increase by whatever that duration is. So the price of the bonds are going to increase by 5.49% plus the yield you were getting. So the total return between price appreciation and the yield would be 9.33%. Okay, and you can see if we do continue to see rates drop, now we're not totally convinced that intermediate and long-term rates are going to drop another percent over the year. Not saying it can't happen, but if it does, look at some of the returns you can get. Right. So if we look just let's look at the third one down there, the Bloomberg US Corporate Bond Index, 5 to 7%, almost 10% rate of return. Longer term bonds would obviously do really well if you get down more towards the 30-year US Treasury at the very bottom, when you have 16 years of duration plus a 4.73% yield. That's how you get to 20% rate of return. This slide is only showing us if rates dropped, what would happen by 1%. Obviously, if we reverse it and interest rates went up, then the price of our bonds would go down. Now you'd have the yield that would add back some return, and we don't have those numbers on here. This is more so if rates dropped. But it's a pretty impressive slide here showing us the potential for rates and duration to add some really nice returns to the bond side of things. All right, the Federal Reserve, I mentioned it earlier. The Fed in September 17th, we saw a rate cut for the first time this year. You can see that we were kind of holding steady in 2023, 2022 at the very top there. Last year, at the end of 2024, we saw a full 1% cut on the federal funds rate, and then a pause for the first 9 months of this year. Okay. The Federal Reserve has a dual mandate, is to help control inflation Drew's going to talk about inflation more in a couple of slides. So on the inflation side of things, if we're around 3% or slightly less, inflation has been held in check. There were some concerns when it came to tariffs and whatnot, but it doesn't seem like that has added much on the inflation side of things. And then also employment, which Drew's going to talk about as well. A strong labor market is important, obviously, and the Federal Reserve, that's one of its mandates, is to try to promote an environment where employment and labor is strong. That part of the economy has started to weaken some. With that, plus slightly lower inflation, that means the Fed cut. Gave it a reason to cut. During the meeting, there was a expectation that the Fed would cut two more times this year, October and December. So you can see market expectations and the FOMC year-end estimates right around 3.6, 3.7. Okay, so yeah, the thought is the market's anticipating it. The Fed even said so that we will probably get two more cuts this year if you get 0.25 and 0.25, so about a half a percent in terms of interest rates coming down on the federal funds rate. And you can see going out, not a lot in the way of cuts just projected just yet. This curve was much steeper when we were looking at this, 6 months ago, 9 months ago. But now it looks like the expectations are we're not going to drop a ton more after the end of this year, maybe a couple more times over the next year or two. But the market likes lower interest rates. It's priced it in. So hopefully we see that come to fruition. If not, then you can see some volatility in the markets. So we'll be watching this very closely as the 2025 calendar comes to a close. Drew is going to talk about some of those economic updates for the next few slides.
All right, thanks, Evan. So as Evan mentioned, the Fed, while they look obviously at a lot of things in regards to the economy, they have what they consider to be a dual mandate, of which is inflation or steady prices and the labor market or strong employment. And what we're looking at here is the Consumer Price Index, CPI, which is one of the primary measures of inflation. And if we look at the far right, the most recent release for August inflation was a positive 2.9% from a year prior. Now, they have not released September yet due to the government shutdown. So, if the government reopens here soon, then we should shortly be getting that data. Actually, I take that back. I believe they're actually going to release September CPI at the end of this month. We haven't been getting jobs data and things like that, and we won't. But they are going to release CPI just because there are things like Social Security, cost of living adjustments that are tied to that. So that they do intend to actually release that. So we'll see what September was here soon. But as we can see here, it's actually ticked up the last 3 or 4 months. From where it was, it got down to nearly, close to 2.5, 2.6%. So it has trended a little bit higher the last few months, but still, meaningfully lower than where we were a year or two ago when we were in the 3.5% range. And then obviously a far cry from the peak at 9.1% in June of 2022. And then these different colors are what make up inflation. And as you can see, shelter, which are rents, and then they have a rent equivalent calculation for mortgage payments. So half of the prices have been made up from shelter, and then the other largest contributor is dining, recreation, and other services. So, one thing to point out here is one of the fears in regards to tariffs being implemented at a level we haven't seen, in nearly 100 years was that it would really drive inflation. And thus far, we haven't seen that come through in the data. So as of now, tariffs have not really added to inflation. As a matter of fact, most data indicates that the places that we are importing from, so the exporters, are actually eating those costs. So the Fed has a 2% inflation target. So clearly we're still above that. But, they reached their peak rates back when inflation was all the way up here. So since it's come down relatively steadily, not as low as they want it, but since it's come down, it's given them room to cut a little bit. And we'll see what September looks like, and obviously as we track through the fourth quarter. But as I pointed out, oil and gas is coming down. So this green bar here, energy, it's actually been uh, subtracting from inflation this year, and we've gone even lower in the last month or two. So we'll see what that looks like coming here forward. So as Evan said, inflation's down, and that's one of the reasons the Fed's felt comfortable in beginning to cut rates again. I think the primary driver of the recent cut and the expected future cuts is what's happening in the labor market. So, as we can see here, these are the monthly net jobs that have been added on any given month. And then the line here is the 3 month moving average. So we can see, going back to the beginning of 2023, we've been hovering, we were all the way up at 300,000 when we were still kind of regaining jobs coming out of COVID at that point. And then since then, we've been kind of hovering between the 100 to 200,000 net job additions per month. But as we've come into 2025, we've seen that fall off pretty steeply as we entered May at about 100,000 on the moving average. Over the last 4 months, now we're down to, I believe that's right around 30,000 net jobs. So I think a healthy job addition is about 100,000 jobs in a given month. A robust is 200 plus. So we're well below that. And with the labor market starting to stall out, the Fed is feeling comfortable cutting rates. And there's a handful of factors that are potentially causing this. A few is simply immigration. There's not been, the southern border has effectively been sealed, and we haven't seen immigration across the border. And we don't have this data, but if you go back to 2019 through the end of 2024, all net job gains were actually foreign-born workers. So with that starting to fall or kind of just stop, we've seen a stop there. And then also the federal government has laid off several 100,000 this year. So that obviously trickles into these numbers. And then we're starting to see a lot of these larger tech companies cut, more lower level jobs as AI is able to do more and more. So we've got kind of a confluence of factors working against the jobs market right now. So we're going to obviously continue to track this closely, but I think this is the primary reason that the Fed's been able to cut. We don't have the first and second quarter GDP data. The first quarter was negative 0.6, entirely due to high imports from companies front running the tariffs, which they knew would be implemented in April. We saw that completely reverse in the second quarter with GDP up 3.8%. In the Atlanta Federal Reserve Bank, which is, kind of their primary data point that they track, is they give I think twice a week they will release estimates on GDP for the most recent quarter. And right now they're all the way up at 3.9% GDP for the third quarter. So GDP remains resilient. And, as we're seeing a lot of build outs with AI and data centers and things like that, that's been very positive in contributing to GDP. So overall, there's kind of a mixed bag in the economy. There's a few negative factors that's allowing the Fed to cut. And then despite that, we're still seeing solid economic growth in terms of GDP. And to wrap things up, we'll kick it back to Evan, and he'll run through a handful of market perspectives as we move our way here through the fourth quarter.
All right. Thank you, Drew. Just wanted to finish with, again, like we always do, with some market perspectives that give us some history in the markets and just some good planning topics and investment principles that we want to make sure we're following. What we're looking at here is risk investing and the power of compounding. Okay, this is the change in purchasing power by investment in major asset classes. So we talk about large cap stocks, small cap stocks, corporate bonds, and cash. Okay, so if we look, we start with cash. If you started with $10,000 in 1995 and kept it all in cash, the purchasing power today of that 10,000, because it has been eroded by inflation, is now 9,198. So you can see leaving the money in cash has lost to inflation. Okay, so how do we keep up and beat inflation? Corporate bonds, which is again fixed income that is not as risky as the equity markets, but definitely takes on a little bit more risk than cash. The $10,000 in corporate bonds grew to a purchasing power of 23,182. Okay, and then on the large cap and small cap stocks, 81,867 and 79,189 in terms of small cap. So the best way to beat inflation is to be invested, whether that is corporate bonds, small cap stocks, large cap stocks. Stocks obviously outperform over time, and this is since 1995. So if you have this kind of time horizon on your side, it is very important that we're investing for a long term. Now, your risk tolerance is going to determine how much you take on in terms of stocks versus bonds, but being in the market is the best way to keep up and exceed purchasing power over time. All right, this is our asset class returns, our asset class quilt that we're looking at here. It's just a good visual to go through to see what the year-end returns were for these different asset classes. So if we look at 2024, large cap stocks were the best performers at 25%, then small cap at 11.5%. And as you move down, the worst performer last year of these asset classes was fixed income at 1.3. Okay. If we go year to date, emerging markets is the top performer. Developed market equities, international stocks at 25, then large cap. And as you go all the way down, cash is the worst performer. Okay. You can just track a color across the years and you can see how the market's rotating around on which one wins one year versus the next year. And that's why in the middle, the white box, the asset allocation piece, does the best job of consistent performance in terms of risk and also and returns over time to say, hey, we're not going to be the top category, but we're not going to be the bottom because we have a nice asset allocation based portfolio of these different asset classes, much more predictable, definitely much more predictable from a planning perspective for us. And so I thought this was a good piece to look at in terms of, hey, you could try to pick one and hopefully every year that's the best performer, but the best way to do it is to have a nice diversified portfolio. We are 22 days into a government shutdown currently. And so the duration of government shutdown, this is what this slide is showing us here. The average length of a shutdown going back to 1976 has been 8 days. The vast majority of the time, these shutdowns ended pretty quickly. Right there in the 80s, you can see there's 2 days, 1, 3, 3, 2, 1, and so on and so forth. The longest shutdown since 1976 was 2018 at 34 days. We are currently into the second longest shutdown since 76. The important thing to remember here, it's not on this slide in particular, the market usually does fine and kind of shrugs off government shutdowns, a lot of times because they are so short-lived, but the market knows they will resolve the government shutdown. And so kind of like some geopolitical events that we've seen over time, just different one-off events like a government shutdown tends not to have a big impact on stocks. Usually the more impactful stock market events would be recessions and just fundamentals breaking down. Currently, like Drew said, the third quarter GDP is looking to be pretty strong. We're at below 4%. So the fundamentals of the economy are still strong. So despite the fact that we're in a government shutdown, the market has not been overly concerned about it. The S&P 500 3-month return windows. What's the best returning 3-month period over a calendar year? And you can see how this works. The first one is January, February, March. So the first The average return since 1950 over the first quarter is 2.1%. Looks like the positive percentage, which is the plus sign up there, what's that, around 60, 65% maybe, of the time that quarter will give you a positive return. The next one's February to April, and so on and so forth. So it's a rolling 3-month time period. What we're looking at here is what's the last quarter of the year look like, October through December. Average historical return from 1950 over that period of time is 4.2%. That's the second best 3-month time period, but it is the best when it comes to the percentage of the time that the market is positive over that 3-month time period at 80%. So we would love for that to continue. We'd love to see the first 9 months of the year having such a good overall return continue through the rest of the year. And if history rhymes or can come close to repeating itself, hopefully that's the case, and we finish the year even stronger than we are now. Okay, so Drew mentioned again, in October 2022 is when we are at the bottom of a bear market. Since then, we've been in a bull market. Okay, so bull market's when you're up 20% from the bottom, and you continue to be in a bull market until you see a 20% drop. And historically, the S&P 500 performance in each of the years of a bull market, there's a lot of thoughts, oh man, the market's really highly priced. Are we close to a correction, a bear market, whatever that might be? The fourth year of a bull market, historically, if you look at these ones on the screen, it's actually pretty good on the far right-hand side. The average return of year 4 of a bull market, which we just entered, is almost 13% per year during the year 4 of those bull markets. So just because we are at a high doesn't mean that we're due for some type of a pullback or correction. Maybe we are, maybe we aren't, but that's going to be based on fundamentals. That's going to be based on corporate earnings, the economy, credit markets, all those types of things. So we're currently, again, like Drew said, there's some data that's hit and miss when it comes to the economy, but overall still fairly positive. We are not doing this live, so we can't take any questions at the moment. But as you watch this, please feel free to call us, email us any questions you have after you've watched the presentation here, and we always welcome questions and would really hope for some. Reach out to us and give us a call, and we can walk through those with you. Going to run through the last couple of slides here. It's going to go through disclosures because we're required to. And as we click through these, we will be doing a live version of this presentation in January via webinar. It's not set in stone yet, but we are likely doing a Social Security presentation as well coming up here. So be on the lookout for that. But thank you for your time. And again, please reach out with any questions. But until then, we'll go back to work for you.